You sit down to refinance the house. The lender pulls a number from a screen. You assume that number came from Jerome Powell. It did not. It came from a different number entirely, and right now that number is doing something the Federal Reserve cannot fully control. If you are a homeowner with a mortgage, a buyer waiting on rates, or anyone holding variable rate debt, I want to fix one thing in your head in the next 10 minutes. Most of financial television gets this wrong. I have seen the confusion in my own family, so let me show you what is actually happening. Here is the part that matters. The Federal Open Market Committee does not directly set the federal funds rate. According to the Federal Reserve, the FOMC sets a target range. Banks then trade overnight at rates inside that range. That is what the Fed controls. Your 30-year mortgage is not priced off that range. Your 30-year mortgage is priced off the 10-year Treasury yield, plus a spread of about 1.5% to 2%. As of May 1, 2026, that 10-year yield sits at 4.39% per Y charts. That is the number doing the work in your monthly payment. So when the Fed holds, cuts, or hikes, your mortgage does not move in lockstep. It moves with the bond market. Hold that in your head because everything that comes next sits on top of it. Now look at what just happened on April 29th. The FOMC held the federal funds rate target range at 3.5 to 3.75% per the Federal Reserve. That is the third hold in a row. On the surface, nothing happened. Underneath, something almost unprecedented happened. 4 officials dissented out of 12 voting members, per the American Bankers Association Banking Journal. 1 wanted a rate cut. 3 others objected to language even hinting at future cuts. That is the most divided Federal Reserve vote since 1992. Picture the room. 12 people, 7 board governors, the New York Fed president, 4 rotating regional presidents. They voted, and a third of them refused to sign on with the majority. Some of those dissents pulled toward easier policy. Others pulled the opposite direction. Now ask yourself a real question. If the people inside the building cannot agree which direction is up, what does that mean for the bond market that sets your mortgage? Some say internal dissent is healthy. The committee is wrestling with hard data. That argument has weight. I take it seriously. Healthy debate produces better decisions. The problem is what dissent does to the 10-year yield. Bond traders read disagreement as uncertainty. Uncertainty widens spreads. Spreads sit on top of your mortgage rate. So even if the dissent is intellectually honest, the bond market still charges you for it. Here is what makes the timing sharper. Jerome Powell's term as chair of the Board of Governors ends May 15, 2026. His term began May 23, 2022. That is a hard date. The next person in that chair is almost certainly going to be Kevin Warsh. On April 29th, the Senate Banking Committee voted 13-11 to advance his nomination, per CBS News. That is a party line vote, but it puts his confirmation on the Senate calendar. A useful detail most coverage skipped. Powell is not leaving the building. As of May 3rd, he is still the current chair. His seat as a member of the Board of Governors runs until January 31st, 2028. The Department of Justice closed its investigation into him on April 24th per CBS News, so he can stay as a governor without that overhang. Some frame his decision to stay as a power move. The more accurate read is institutional continuity, a steady hand on the board while the chair role transitions during a deeply divided moment. That nuance matters because it changes how markets price the transition. Now to the part that should change what you do this week. Warsh has publicly argued for 2 things at the same time. Cut the federal funds rate. Also shrink the Federal Reserve's balance sheet. In theory, those 2 moves are complementary. In practice, they pull in opposite directions on your mortgage. Let me show you why. The Fed's balance sheet ballooned over the last 15 years, from under $1 trillion in 2008 to about $4.5 trillion by 2015 to over $7 trillion by mid-2020, peaking at roughly $9 trillion per the American Action Forum. The way the Fed grew, it was by buying Treasury bonds and mortgage-backed securities. That buying lifted bond prices, and here is the rule that runs everything from this point forward. Bond prices and bond yields move in opposite directions. When prices rise, yields fall. When prices fall, yields rise. That is not opinion. That is bond math. So flip it around. If the Fed reduces its balance sheet, it is selling or letting bonds roll off. That increases the supply of treasuries hitting the market. More supply, lower prices. Lower bond prices mean higher yields. Higher 10-year treasury yields mean higher mortgage rates. Picture this. Warsh walks into the chair role May 15th. He cuts the federal funds rate by 1/4 point. The headline says rates are coming down. Meanwhile, behind the scenes, the Fed accelerates balance sheet reduction. Treasury supply jumps. Yields rise. Your mortgage offer at the bank goes up, not down. Same week, same chair. Opposite direction from the headline. You might be thinking, fine, but Warsh is smart and the strategy is grounded. He has criticized the bloated balance sheet for years, and his approach is deliberate, not reckless. That is the strongest version of the case for him, and it is fair. I take it seriously. The problem is not whether the strategy is intelligent. The problem is that running a multi-trillion-dollar balance sheet reduction at this scale has not been done before. Direction is not the same as execution, and the bond market will not wait for the strategy to be proven before pricing it. That is why the 10-year Treasury yield at 4.39% matters more than the headline rate decision. The yield is where the policy actually lands on you. Now zoom out. Why can the Fed not just choose the right policy and end the debate? Because of a constraint nobody on the FOMC controls. The U.S. national debt sits at $38.95 trillion as of May 3rd, per the Treasury Department. In fiscal year 2025, net interest payments totaled $970 billion, and total spending for net interest crossed $1 trillion for the first time per the Congressional Budget Office. That is more than the entire defense budget. Approximately 18 to 19 cents of every dollar in federal revenues now goes to interest payments alone, per the Peter G. Peterson Foundation. Translate that. For every tax dollar Washington collects, almost 1 out of every 5 goes straight to bondholders before it can fund anything else. Not roads, not Social Security checks, not defense. So when the Fed thinks about cutting rates, it is also thinking about how higher yields would compound that interest bill. And when the Fed thinks about holding rates, it is also thinking about whether the economy can absorb borrowing costs at this level. There is no clean choice. The debt math constrains every move. Before I give you the actions, I want to Steelman the case for sitting still. Some argue the rate hold is not paralysis, it is patience. Oil prices remain elevated. Brent crude at $108.17 per barrel as of May 1st, per Trading Economics. The Federal Reserve flagged inflation as still elevated, partly due to global energy prices. Federal Reserve commentary in early May indicated the U.S. employment market is nearing full employment. The April Beige Book described a K-shaped economy, financial strain among lower-income households while higher-income spending stays resilient. With inflation upside risk on one side and labor strength on the other, sitting still is a defensible position. I do not dismiss that view. The structural debt constraint still applies regardless. Patience does not unwind $9 trillion of balance sheet. It just delays the question. So here is what to do before May 15th. 3 moves, none of them require predicting the future correctly. Move 1. Audit your variable rate debt, not your fixed mortgage, your HELOC, any adjustable rate mortgage, your variable car loan, any business line of credit tied to a benchmark. These instruments reprice when yields move. If you have the option to convert to fixed, have that conversation with your lender this week, not next month. Some pushback is fair here. The link between the 10-year yield and every consumer rate is not always immediate, and conversion options vary by lender. The point is to know your exposure before the transition, not after. Once a regime change is priced in, your conversion offer is less generous. Call the lender, ask the question, get the number. Move 2. Stress test your monthly budget against higher rates, not lower. I keep seeing households model what happens if mortgage rates fall. Almost no one models what happens if they stay flat or rise 1%. On a $400,000 mortgage at 7%, the principal and interest payment runs roughly $2,661 per month. At 8%, that climbs to about $2,935 per month. That is $274 more every month for 30 years. Run that math against your real budget. If the higher rate scenario does not break you, fine. If it does, you have time to adjust now. Move 3. Reduce your reliance on dollar cash as your only inflation hedge. Cash earning 4 to 5% feels safe. It is exposed if real inflation runs higher than the headline. Real assets with fixed-rate financing locked in at today's rates, equity in businesses with pricing power, and diversified positions are less exposed to dollar purchasing power erosion than cash sitting in a savings account. This is general education, not a recommendation for your specific portfolio. Talk to a fee-only financial advisor or a CPA who knows your full situation before you reposition anything. They will catch wrinkles a video like this cannot. So back to where we started. The number that prices your mortgage is the 10-year Treasury yield, currently 4.39%, not the federal funds rate. Powell's chair term ends May 15th. Warsh wants cuts and balance sheet reduction at the same time. Bond math says those moves do not cancel. They fight each other inside your monthly payment. The Fed cannot escape the debt constraint, and the bond market will not wait for the strategy to prove itself before pricing it in. Which brings up the next question, the one I want to leave you with. If the Fed transition reshapes the bond market, what does that do to the so-called safe portion of your retirement account, the bond allocation most people assume is the conservative bucket? May 15th is a date that matters for more than just your mortgage. Most savers have no idea what is actually inside that safe sleeve of their nest egg right now, or how a chair handoff during a divided Fed could move it. I walk through what to check before the transition in my next video. I will see you there.